Hello, this is Steve Morris with this introduction to financial projections. Now, sales forecasts or projections are indeed a challenge for a startup. You're in probably an emerging market. You've got a new company that has no history in terms of sales. There's probably nothing out there that's a directly comparable company. You're probably a little bit different than everything else, or at least hopefully you are. And there's no sure way to predict how fast customer adoption will happen when you're selling something that's new. So, how do you do it? How do you predict or project the future? Well, the approach I suggest is do bottom up, do what I call behavior based or activity based forecasting. And each step of the way, you will be making assumptions. You'll need to document those assumptions, and you'll need to go research those assumptions to make sure that you can defend that, yes, these are actually reasonable assumptions. So, what do we mean by assumptions? Well, here's just one possible set of examples. Let's say you're selling a fairly expensive product, and you believe, based on your customer research, that a typical order will be $20,000. And you believe a few other things. You believe that based on perhaps the team's own experience in this market in the past, or based on talking to other people that have experience selling this kind of a product in this kind of market, you think your sales cycle will be 6 months. That wouldn't be unusual for a $20,000 purchase. And you believe, again, based on experience, based on talking to people, that the marketing investments you'll make will yield 20 leads per month. And again, based on the research you've done, you believe that somewhere around 10% of those will close, again, typically over that 6-month sales cycle. And you believe that it'll take a couple of salespeople to keep up with that level of lead. So your plan might be, or your assumption might be, that we'll hire 2 salespeople in January. And you also might be assuming that it takes some time to train salespeople. That's very, very common. They're not instantly productive once you first bring somebody on board. It takes some training. Now, that all would net out to $40,000 in expected orders starting at September. Why September? Well, you bring them on in January. You're training them for 3 months. Then they're starting to work the leads, and you expect a sales cycle of 6 months, and that takes you out to September. So just an example of what a set of assumptions might be that would lead you to estimate when sales will start and how much. Now, of course, over time, you'd probably add more salespeople, add those assumptions, and that means you'd be expecting your sales to ramp. Of course, all of these assumptions also drive your cost estimate, right? These salespeople obviously will cost you something in terms of salary and commissions and travel expenses and so forth. Now, things to think about as you think about your revenue forecast. What is the sales channel that you'll use, and how long will it take to make it productive, whether it's direct sales or whatever? Your typical channel is not instantly productive. What will that channel cost? Channels typically involve something like salaries if it's direct sales, or at least a discount through the channel. So what's the cost of a channel? How long is the sales cycle? These are all things you figured out either based on the experience the team has from other companies or based on talking to people who've sold into this market or a similar market before. How will you create demand and create leads? And how much will you invest in that creation, in other words, in marketing, and how many leads do you believe that will generate? What do you believe your conversion rate will be? If you think we'll get this many leads per month, how many of those do you think will actually turn into orders? And of course, again, how long will that take? And by the way, you also want to look at how long it will take customers to pay, how long to go from an order to actual cash in the door. Then step by step, the question is, how will you make sales happen that first month? What exactly will you do? Who will you hire? What money will you have to spend to make it happen? And then the second month and the third month. It's very much month-to-month activity-based with all of these underlying assumptions. Now, you're doing the same thing on the cost side. What will those things you're doing each month cost you? You probably have to pay rent, maybe some recruiting fees, salaries, benefits, possibly commissions to your salespeople. You might have to buy some equipment, travel, go to conferences, shows, office supplies, lots of things to think through. But again, you can think through based on the assumptions that you've made on how quickly you'll bring on people and so forth. What will those month-to-month activities be? What will they cost? And then once you do that for month 1, of course, you do it for month 2 and 3 and 4. And remember that your expenses do tend to scale. One mistake startups or first-time entrepreneurs often make is to assume that revenue is going to scale hugely, but, oh gosh, we really won't have to add anybody in R&D. So, well, your expenses really do tend to scale along with expenses, so don't make that mistake. Again, get some advice from those who've built a business or from a CFO. So the idea is you're making educated assumptions, okay, call them educated guesses. You execute on those. You measure what actually happened. You made an investment in marketing. You assumed you get this many leads. Well, first month, what actually happened? You learn from that and you make adjustments. So sure, it's a little more of a guess when you first put these assumptions in place, but pretty quickly as you go down the road, you start getting smarter because you start learning from your actual experience out there in the market. One thing that helps is to use a financial projection template, some kind of a tool for putting together projections. If nothing else, it reminds you of different cost categories that you should think about to include in your model. Score, by the way, in their Portland, Oregon office has a very good tool for doing that. It just costs $40, and they can provide you with some free consulting to help you actually figure out how to use it. It's a good resource to take advantage of. Don't forget then to do a sanity check. How do you do a sanity check? Well, first of all, compare it with others. Go find other entrepreneurs out there that maybe have built a similar business and who are just a little further down the road than you are. Or go find a business that got bought by a public company and they probably had to publish some financial information in their 10K reports about that. Or go find a CFO who's experienced in working with this kind of a company. You really want to do some kind of a reality check. If you're ramping faster or have higher profit or lower spending in R&D than any other company ever has, that's good cause for thinking about whether that's a realistic assumption. So again, certainly get your advisors involved, particularly a CFO experienced advisor, in going over your numbers. And the other sanity check is to think about investors. If you will be pursuing investor funding down the road, then a reasonable question to ask your advisors is, will this kind of a revenue ramp and this kind of profit attract investors? Some businesses are just tough to pitch to investors. If you're projecting 5-6 years down the road, you'll have only $2 or $3 or $4 million in revenue. It's very hard to make those numbers pencil out for the typical investor unless it's an extremely capital and effective business. So get some input from your mentors. If you'll be pursuing investor funding, find out if your projections really are describing a business that an investor would be interested in. And then, of course, you'll iterate. The first time through your projections, it most likely will not pass one or more of the sanity checks. So what you're doing is developing projections, going through that sanity reality check, learning from that, and doing some adjustments. And then over time, of course, each month you get more information. And again, you'll be learning and you'll be adjusting. And month to month, your projections will just start to get better and better. So in summary, yes, you do need financial statement projections. You'll need it to get funding, whether it's from a banker or an investor, and you'll need it just to be able to predict and plan your own business, to really understand your cash situation. Managing cash is just critical because obviously you don't want to run out of the stuff or it's game over. And you want to, in fact, identify cash issues early enough that you have time to act. Figuring out you'll be out of cash at the end of this week is a pretty tough thing to react to. If you know you're going to be out of cash in 3 or 4 months, it at least gives you time to implement some strategies to try to deal with that. take a bottom-up sort of behavioral or this sort of activity approach, and there'll be at least some reality to your numbers. And remember, document those assumptions and research them. Talk to other entrepreneurs, talk to CFOs. Make sure that you've done enough research to be able to defend those assumptions. That'll make you feel better. It'll also make investors more confident that those financial projections you put together actually could happen. And when it comes to investors, that's the goal. They know that your projections are wrong. You have to convince them that it could happen. So I hope that's helped. A quick introduction to the art of creating financial projections for your business.